Hello and welcome back to Cryptocurrency Trading, Mastering Scalp Trading Strategies by Wealthy Education. In this video, we'll talk about wedges and triangles. So a wedge or a triangle is essentially the same thing. They come in different shapes, and all it is would be the consolidation of price. So you can see why these are called triangles. And there are three different flavors, as it were. So in this case, you have a symmetrical triangle. In this case, you have a descending triangle. In this case, you have an ascending triangle. Triangles should be broken before the 80% level to the apex. Furthermore, they come with a built-in measuring stick in the height of the triangle. So, for example, let's just say the top to the bottom of any of these triangles is $10. Well, your target when you break out is $10. But I want you to think about what's going on here, because this is a symmetrical triangle, meaning that pressure is increasing from both sides. That makes it more or less like a 50-50 play. An ascending triangle shows that the buyers are becoming more and more aggressive, and the defenders, the sellers, are trying to defend this area here at the top. Breaking that obviously causes a lot of short covering and the move to the upside. A descending is the exact opposite. Sellers are becoming more and more aggressive. They eventually, at least in theory, break down through the support and the market goes lower. Pretty straightforward stuff. Now, wedges are just triangles that look more like this. So in other words, price is going higher, but it's constricting, and then eventually you drop. This is a rising wedge. Price is going lower and lower and lower, and then finally you break out. So think about what's going on here. You are having a harder time going higher over time. You're having a harder time going lower over time, so it's a potential reversal. As a general rule, you are aiming for the bottom of the pattern in a rising wedge and the top of the pattern in a falling wedge. One thing to keep in mind, though, is when it comes to wedges, it's the exact opposite of what it sounds like. So a rising wedge is not something that's going to produce rising prices. It's the exact opposite. So let's go ahead and get rid of all of these drawings, and let's just take a couple examples out of the wild and go from there. So when you look at triangles, shorter time frame triangles are not going to be as reliable as a longer term. And that is true with everything technical analysis related. That is one of the parts that makes scalping kind of difficult. It's because you get these signals here. And, they may or may not have as much information behind them as, like on a weekly chart, for example. But you can see this descending triangle definitely hit its target. And in this case, you just put your stop loss on the other side of the pattern. Let's go ahead and get rid of that. So that was descending, and that meant that the sellers are becoming more and more aggressive. This is an ascending triangle. You finally break out, you put a stop loss below the triangle, you definitely hit your target without any issues. Let's go ahead and take a look at, let's just look at Bitcoin. So that hasn't, this could be, in theory, a falling wedge, but it remains to be seen. We don't have confirmation of that because the price hasn't gone beyond there yet. Again, here's an interesting symmetric triangle. So at this point, we had recently rallied, and now you're wondering, hey, this pullback, is it going to be a buying opportunity? Turns out it wasn't. Stop loss goes on the other side of this, and you definitely hit your target. So that was literally a 50-50 proposition at that point. Little bit of a rising wedge here. Buyers ran out of steam pretty quick. We got right back down to the bottom of that wedge. Over here, you can make an argument for an ugly falling wedge. And clearly we got there. So in the next video, what I'm going to do is I'm going to take some extra indicators and show you examples of how you would trade this in the real world instead of just looking for the patterns, but getting other signals that perhaps it's time to buy or sell. Hello and welcome back to Cryptocurrency Trading, Mastering Scalp Trading Strategies by Wealthy Education. In this video, I'm taking a look at some examples of how to trade wedges and triangles. So the first example that I have is a symmetrical triangle. And you look at this and you say, okay, well, we're in an uptrend as of late. So it does make a certain amount of sense that perhaps we go higher. That being said, it's a symmetrical triangle. So it still shows uncertainty and indecision. Look at this crossover here on the 9 and the 20. And that opens up the downside. And at that point, we most certainly hit our target. It's pretty straightforward. Gotta like that a lot. I like it when it's simple, it's straightforward, it does what it's supposed to. Because, you know, the thing is nothing's 100%. It doesn't always do what you believe it's going to do. Here's a descending triangle. Again, the crossover, and then we break down below it. We hit our target as soon as we break out, basically. And typically, and this is not uncommon, you actually get more out of it than the original target. What I do find a bit interesting about this is if you miss the initial surge lower that made up the triangle, pull back to 38.2, that's where that downtrend line came and we collapsed from. So definitely worth paying attention to fibs in these short-term moves, because a lot of traders that are going to be taking these technical patterns like this also use Fibonacci because they're not concerned about whether it's real or not. They just use it as a tool. And therefore, you know, it gives you a little bit more of a technical setup in general. So let's go ahead and take a look at Ethereum. So I see this little resistance barrier here, right? So it doesn't take much to think of this as a triangle. The moving averages break above and spread out on a little bit of volume, a little bit of extra volume. And we obviously hit our target, but looking at this fib, you can see that the 50% is right where we started to bounce and form. And on top of that, you could make an argument for a longer term double bottom. So that is a feasible setup there. A little bit of a falling wedge. We're falling right back into it after rallying. So breaking above the top of it takes off to the upside. So some of you may look at this and go, this kind of looks like a pennant. And the pole itself, I don't like it. It's not long enough. But a lot of times the two are somewhat interrelated. You know, clearly in that particular case, it meant the same thing anyways. And that's a good thing because you want more traders on your side thinking the same thing, or why they think it's not really that relevant. So here's a rising wedge after a bounce, we pull back and then we fall. Notice how we are right around the 38.2. When we bounce right into these resistance or these moving averages, which offer resistance, and we clearly hit the bottom of this wedge almost immediately. Let's go ahead and take a look at another chart here. Let's go to Ripple. So Ripple, you know, here's a huge triangle. Now, this brings up an interesting point. Some look at the bodies and some look at the wicks. It's entirely up to you. That is one based on the bodies, obviously, that worked out quite well. And that's more or less a personal choice there. Most of the time you see wicks included, but there are some who only care about the body itself because they say that's where the market truly is trading. You know, it wasn't like a one-off for a few moments. And that is something that you can, you know, kind of experiment with and see what works out better for you. So here we have a symmetrical triangle. It is in a downtrend, so we broke lower, probably not a huge surprise. Notice that we're right here at support, so it makes sense that we would pull back a little bit anyways. Your target definitely got hit. Moving average is working with you. You know, the Bollinger Bands were walking along the bottom, as we had talked about previously. And your MACD did cross right there as we broke down. It was already negative, so that probably gives you a little bit of a heads up as to what direction it prefers. So going forward, we are leaving Module 3 and we're going into Module 4, price action scalping strategies, where we actually look at the actual candlesticks themselves, get a little bit more in the way of granularity.